How's it going, guys? Bill here. Today I wanted to go over Teladoc with you and give a little update. They had their earnings yesterday and it went quite well. They had really good earnings to report. So I just wanted to talk to you about how they did with that. And as you can see, today they had a really good day in the market. They were up almost 8% today. Yesterday, after hours, they were down a little bit after the earnings came out, but I think it was mostly people who don't really understand earnings reports that probably caused that to go down. But then the people that do understand them, uh, they came back in force today, and it made a really huge jump. And I just want to go over that report a little bit, get a little in depth on it, and just how I believe that this is just a start. I believe that this thing is just going to keep going. Now, I'm not saying it's going to be a rocket ship from here on, but I believe it's the start of a long-term, huge growth because, as yesterday showed, revenues and so forth are not slowing down anytime soon. So they just keep going and going. So let's take a look at it. So we start looking here, and we can see it says Teladoc posted a narrower than expected Q3 EPS loss of 53 cents versus a consensus of 65 cents. So, though the loss widened when compared to 43 cents reported a year ago. So they were expected to lose 65 cents per share, and they only lost 53 cents per share. So they beat estimates by quite a bit. And the reason they are their losses are more than last year is because of the Livongo stock awards. And it says there the loss included a stock-based compensation expense of $71.7 million. Teladoc managed to grow its top line by 81% to $521.66 million this quarter, beating the consensus of $516.63 million. During the quarter, the company saw visits jump to 3.9 million, which is up 37% year over year. Paid memberships in the U.S. were 52.5 million, which are up 2% year over year. The average revenue per member per month was $2.57, up from $1.18 last year and $2.47 in the second quarter of 2021, so last quarter. One of the big numbers here is adjusted Ebitda was $67.4 million compared to $39.5 million a year ago. Not only did they beat numbers, but they also raised their guidance, which is probably even more important. They forecast sales of $2.015 billion to $2.025 billion, with an EPS loss of $3.40 to $3.20, compared to their earlier guidance of $2 billion to $2.025 billion in revenue and a $3.60 to $3.35 per share loss. So, to me, that's probably where a lot of the improvement came from. People were happy to see that raise in guidance. On top of that, their CEO had some strong things to say. Our strong performance in third quarter reflects our continued success in leading the transformation of healthcare delivery and expanding access for all, said Jason Gorovic. Leveraging our unique combination of data, analytics, technology, and dedicated healthcare professionals, we are driving growth across our business. The third quarter was notable in expanding relationships with a number of leading national health plans. With the successful launch of our Primary 360 offering, which reimagines the primary care model and delivers increased access and engagement to members. So the Primary 360 is something that's just started, so that's just now going to start showing and will only grow. As we look ahead to the rest of 2021 and into 2022, we are confident in our ability to innovate, anticipate, and solve for the evolving whole person health needs of consumers and healthcare professionals globally. We dig a little deeper into the numbers here that they put out, and you see that their revenue year over year growth for the quarter ended September 30th grew 99%. And for the 9 months ended September 30th, grew 133% year over year. Their total revenue grew 81% year over year for the quarter. And for the 9 months ended in September 30th, it grew 108%. That is just absolutely massive growth. Their total visits year over year for the quarter grew 37%. And for the 9 months, it grew 39%. So huge growth right there also. So we see the net loss was $84.3 million for the third quarter of 2021 compared to $35.9 million of the third quarter of 2020. So that did grow. And the net loss was $417.8 million for the first 9 months compared to $91.2 million for the first 9 months of 2020. The third quarter and first 9 months of 2021, though, include stock-based compensation expense of $71.7 million and $241 million, respectively, representing increases of $50.8 million and $179.8 million, respectively, from the third quarter and first 9 months of 2020, substantially reflecting higher expense associated with Livongo stock awards that continue to vest after the merger. So that's the reason that the debt, or that they keep looking like they're losing more money. But that's not going to last forever. They're going to have that paid off before long, and they're going to show that they're going to start getting closer and closer to profitability. They're closer than what those numbers look like. Their Ebitda also was a loss of $8.7 million for the third quarter compared to $6.8 million compared to a loss of $6.8 million for the third quarter last year. And Ebitda was a loss of $72 million and $15.4 million, respectively, for the first 9 months of 2021 and 2020. But that also includes the stock-based compensation. So when you look down here at the adjusted Ebitda, it was $67.4 million for the third quarter of 2021 compared to $39.5 million for the third quarter of 2020. Adjusted Ebitda was $190.8 million for the first 9 months of 2021 compared to $76.5 million for the first 9 months of 2020. So when you look at that adjusted Ebitda and it has that stock-based compensation out, you can see how the company is growing right there, and it's getting closer and closer to having that paid off and getting closer and closer to profitability. Now let's take a look at what this article says about some of the features of Teladoc and why it looks pretty good. So as it says, Teladoc shares fell in the after-hours trading yesterday, but it wasn't because they missed on Wall Street's top or bottom line estimates. It was because Teladoc beat revenue and earnings expectations. The reason it seemed is because they were fretting about slowing revenue growth. But obviously, as it says, revenue was going to slow down after the COVID-19 momentum slowed down. So there wasn't so many people when COVID started wanted to go virtually that it kind of pushed the numbers farther in the future already. So, or it brought it to them from the future, I should say. And so they have to slow down because the people that were going to make the growth faster are already in there. So one thing to look at are their key metrics are trending upward. First, even though the revenue might have slowed a little bit, they're still growing extremely fast. The company reported revenue in the third quarter of $521.7 million, which is up, as we said before, 81% year over year, and up 4% from the previous quarter. But that's not the only key metric to look at. Total visits rose 37% year over year to 3.9 million. That total is a nice bump from the 3.5 million visits in the second quarter. Even with most lockdowns a thing of the past, people are still choosing to receive care virtually. Utilization is also up to 23.7% from 16.5% in the prior year period and 21.5% in Q2. Chronic care enrollment is at an all-time high of 725,000. Similarly, sorry, I can't speak, guys. Revenue per member per month is better than ever. Secondly, we got a big new contract that's about to become effective. The numbers from this most recent quarter reported don't reflect anything about the new business that a company has won that hasn't been realized yet. Earlier this year, Teladoc landed a big new contract with Healthcare Service Corporation. It's the 5th largest U.S. health insurer. The HCSC deal is a great example of how Teladoc's acquisition of Livongo is paying off. The big insurer will offer Teladoc's chronic care solution for diabetes and hypertension to its commercial fully insured members in multiple markets. After the agreement was made, the Teladoc CEO referred to it as a landmark deal for the company. However, Teladoc hasn't seen any growth from the new contract yet. That won't happen until early 2022. Gorevic, the CEO, expects the growth to continue throughout the next 2 or 3 years. Teladoc's Q3 numbers won't tell you anything about what's on the way with that. And then thirdly, the major partnerships for Primary 360. The Teladoc's latest results don't even hint at the potential for one of the company's most exciting products thus far, Primary 360. The company launched Primary 360 as a pilot 2 years ago. Earlier this month, it made the virtual primary care service available to commercial health plans, employers, and the organization across the U.S. In their Q3 update, the company stated that it has inked major deals with CVS Health and Centene. CVS Health's Aetna insurance unit plans to launch Primary 360 nationwide early next year. Teladoc already has several Fortune 1000 employers actively using the virtual primary care service as well. Primary 360 has helped identify and treat previously undiagnosed chronic diseases and connect members with virtual specialty care services, including mental health support. Now, lastly, let's go ahead and take a look at some of the valuations again. And keep in mind when looking at these, that this hasn't been updated with the new Q3 earnings report. So the valuations you see now are actually going to be better than what they look like on here because revenue and so forth has all increased. So Teladoc's price to book is at 1.38 while the industry average is 4.65. They have far more assets than they do liabilities, so their balance book looks really good. 17.6 billion in assets to 1.6 billion in liabilities. We can see here that since September of 2020, their cash flows have improved tremendously. So that's really all I have for you as far as an update on TDOC goes. Like I said, I think the earnings were outstanding, and I think the sky's the limit for this company. Really, the only knock is that it's losing more money, but that is based on the sales to Livongo, because this time last year they hadn't sold it yet. But starting next quarter, when you look year over year, the losses are going to be compared to the ones with Livongo's sale, because it was this time last year that the sale went through. So it's going to be better comparatively speaking, and eventually that sale will go through all the way, it'll be paid off, and it'll start comparing with, eventually the earnings will start looking better here. When you compare it to what's going on right now, it's going to look way better, and it's going to be a huge jump in profitability. And what do you think is going to happen when that happens? The price is just going to skyrocket. So I appreciate you guys. Please give me a like, give me a subscribe if you got something out of the content, and I hope you have a great night.